What's up, Cash Flow Nation? DavidO here. And a question I keep getting all the time in this market is, where is all the cash flow? What's going on with the cash flow right now? And I wanted to make a quick video for you guys to explain what is happening in our market. It's been an intense seller's market out there, as you guys have known, but many of you guys don't realize, the history of it and how we got to where we are today. I've got on the screen here the median sales price for St. Louis County over the last 17 years. So here you can see the decline here on the left from the '08 crisis, that kind of where we bottomed out in 2012 as far as the price goes in St. Louis at about $131,000. To all the way to where we are here on the far right in 2025, where the median sales price is $270,000. You can see this line for the last 12 years. We have been on an appreciation run like nobody's ever seen before, right? We had the big boost here in the COVID years. We saw incredible inclines. 2023, we flattened out a little bit, and then we're back to the races here in 24 and 25. So prices are appreciating big time to the tune of 8.5% over the last 12 months here in St. Louis for single family homes. So we're up 8.5%. If you bought something a year ago, you're likely 8.5% above that sales price now today in 2025. And so what about the inventory, the amount of homes for sale? Let's take a look at those numbers. So we measure homes for sale in months of inventory. And what that means is when we tell you that there are 1.7 months of inventory in the St. Louis real estate market right now, that means if no new listings came out, everything on the market would be sold in 1.7 months. So that's extremely low. You can see here in the history, the last 17 years, we have not seen really numbers this low since COVID. After COVID, we bottomed out at about 1.1 months of inventory back in 2022. It has crept up very, very slowly. We still haven't gotten to 2 months of inventory. In fact, the last time it was a buyer's market in St. Louis, and typically you say a buyer's market has more than 6 months of inventory, that was way back in 2013, where we had a balanced market. And the last time we had a buyer's market was, the last downturn. So 2012, 2011, 2010, 2009, right? So we have very little inventory and prices are keep going up. So when you guys are complaining that there's no cash flow out there, people are making a ton of money by buying and holding and appreciating those assets, right? And so I wanted to just take a look out there to see if we could come up with just an example deal to show you what kind of returns you're going to get on something that maybe doesn't have any cash flow. So I just went to Zillow here. I plugged in three bedrooms. I'm looking for something a little bit nicer and like a B class type property. So I'm looking in the 150 to 200 range for a 3-bedroom. I went over here and I saw this house in Overland. Now, this is a very well done home. It's got granite countertops in it. It just looks like a beautiful move-in ready house, right? So this is something that's going to hopefully take no investment to rent out. You're going to get a tenant right away. You're going to get a great tenant, somebody that wants to live somewhere nice, somebody that wants to pay top of the market rents for it, and all that. So I started running the numbers on this for you guys so you can see what this would look like. And basically, the list price is $168,900. So we put that in. So let's say we bought it at list price. We got a standard 30-year mortgage on it, fixed rate mortgage with 20% down. Today's rates for an investor will put you right about 7.38%, depending on your credit score. But you're, 7% interest rate. People are scared about that. Let's take a look at what the numbers are going to show us here. Your monthly mortgage payment, so this is principal and interest, is $933 or something like that. I think this property would very easily rent for $1,550 a month. We might be able to push this to $1,595 just because of the how nicely they did this rehab on this property. You might be able to get even more than market for this rental. But just to be conservative here, we're going to go 1550. We're going to account for 5% vacancy. Now, some of you guys say that's low, but all of my tenants, I try to screen tenants that want to be there for multiple years. So if you're getting tenants there for 2 years and you're turning them in about 45 days after they move out, yet that will be exactly a 5% vacancy. So a lot of my rentals have a vacancy lower than this. Really, people that are putting 10% here are turning tenants every year, which is, you don't want to get tenants that are just staying for a year. We've also got property management accounted for here, 10% property management. We've got 10% maintenance reserve. So this is for your repairs, stuff that come up during the ownership period. We've got the tenant paying all the utilities. We've got property taxes of $1,729. We've got an insurance policy, investor's insurance policy of $1,000 a year. So all of this stuff working itself out here. Your net operating income is $935 minus that mortgage payment, because we're financing 80% of that deal, leaves you with a net cash flow of $1.38 a month. And this is what a lot of you guys are seeing in this market. You're trying to buy a nice rental and you're seeing there's no cash flow, right? We have $1.38 of cash flow. So Dave, why would I invest my $33,000 in an asset that's producing so little cash? Well, let me show you why. For one, not only are we having 8.5% appreciation on the value of the home itself, what do you think about the rents? Do you think the rents are appreciating at all? Well, they are, and they're appreciating very healthily. It's about $50 a month increase every single year for the last 3 years in St. Louis. So if you bought something that rented for $1,000 a month 3 years ago, market rent is easily $1,150 a month for that same property. So I've got plugged in here a 3.5% rent appreciation, which is super conservative. I think that would barely get to $50 a month on a $1,550 a month rental. But let's take a look at the cash flow ROI. Now, some of you guys that are clients, you have access to these spreadsheets if you don't reach out to one of your agents. But this is going to show you your returns across multiple different things here. So you're going to see in column S here is your accumulated cash flow. So this is the net cash flow, the $1.38 a month. 12 months in, so a year into this investment, you've got $17 in cash flow. Nothing to get excited about, right? But because the property is increasing in value by 8.5%, a year later, you've got $14,000 in appreciation. So value of the property is going up. You've got your mortgage that you took out on the property. That's actually going down, right? The tenant's paying part of that mortgage for you, part of the principal down for you. So those things are happening. Your rent's going to be going up. So your total ROI on this $1.38 a month cash flow is literally 46% after the first year. And you're going to see here every year your return's going to go up because you're going to start accumulating cash flow. So year 2, you've got $478 in cash flow. Year 3, you're already cash flowing over $100 a month, right? The rents have appreciated. Year 2, you're already at $200 a month cash flow. So your cash flow is going up. The property value is going up. You've got, by the 3rd year of this thing, you're going to start having returns that are in the 60-70% range, right? And in fact, your total return here, when you include the debt pay down, the cash flow, and the appreciation, all 3 of those factors, 3 years from now, you have 155% return. I'm looking over here in column AA. So that is why there's so much competition out there for deals right now, because people are making a ton of money just buying and holding assets, and they're appreciating big time. And so it does make sense that if you're waiting, if you got cash in the bank, why not deploy it in a safe, stable asset like something like this that's already fixed up, already ready to go, and just ride that appreciation wave? Because in a couple years, when the property value is, let's say, $234,000, and your debt on the property is only, or actually you have $65,000 in equity in the property at this point. Or no, $104,000 of property in the property 3 years from now. What can you be able to do with that? Well, you can refinance your property. You can pull that cash out. You can get a HELOC on that equity and use it for other investments. So that's why cash flow right now is so tight, but it's making a lot of sense to investors to still invest.